Those online, thank you for joining us tonight. For those of you who are new to this series, this is part of our Young Alumni series supported by Canvas Credit Union. It's a series we run the second Tuesday every other month. So this is the third part of a 6-part series. We're about halfway done. I know at least one of the people in the room has attended other parts of the series, a couple others online. Last I checked, we had about 20 people waiting online, and we have 3 people in the room. We are using a new camera, so it should pick up all questions, but for those online, if you have any trouble hearing us or seeing us, please pop that in the chat, and myself or my colleague Andrew will help you tonight. For those in the room, feel free to raise your hand and just ask your question like you would a normal workshop. My name is Alexandra Schweiger, and I have the pleasure to serve as the Young Alumni and Student Engagement Specialist for the CSU Alumni Association, which basically means my entire job is to look at how CSU supports our young alums and students as they transition out of school, which is really, really great. This series wouldn't be possible without the support of Canvas Credit Union, so thank you, Kevin and Steven. They really, truly are the experts tonight. I just get to do the awkward little introduction, as well as our CSU Alumni Association members. Members make everything the CSU Alumni Association does possible, so if you are a member online tonight or in the room, a huge thank you. Truly, fully, we couldn't do any of our programming without you. With that though, you didn't come here to hear me talk, so I am going to turn it over to the experts. This truly is a place for you to learn, soak it all in, ask all of the questions, and we will help navigate as it comes up. The last thing I forgot to mention is if you are in the room, the restrooms are just right outside. Feel free to grab snacks, take breaks as needed. If you are online, any technology problems pop up, you can't hear us again, feel free to pop that in the chat too. We will never turn your camera or your microphone on, so Andrew and I will serve as your voice and verbally ask those questions for folks in the room. But with that, I will turn it over to you both.
All right, great, thank you. Well, as Alexandra said, I'm Kevin, and this is Steven. We're both with Canvas Credit Union. We are in the mortgage department with Canvas, so we're not necessarily professional class presenters. We are actual mortgage loan officers. So we've both been in the industry for many years and have seen both the ups and downs that have come through. And but I hope you find that the class is helpful, and I think there's a lot of great information in it. We'll break a couple of different times for questions here in the room. Feel free to raise your hand, and or if you're on the webinar, please post them to the chat board, and we'll have breaks during a couple of the sections here so that we can go over a lot of your questions. Now, it's probably going to feel like I'm, both of us are kind of reading through a lot of these slides again, not being professional presenters, but I do want to kind of keep it fun and light, and just let you know it is kind of a general overview of the home buying process. It's really not going to be specific and answer a lot of the in-depth questions that a lot of people do have. If you do have a really specific question to your situation, or it's pretty high level and in-depth question, we'll certainly be available after the class, or you can contact us even after or offline. We'll be happy to go over a lot of those specific questions. All right, so with that being said, let's go ahead and get started. I think to start off with, I'd like to kind of pose a question to everybody. I guess for the people here in the room, and then online, if you can just post your answers in the chat room. Who here would become a first-time homebuyer, or is looking to become a first-time homebuyer? What are we seeing online?
Nothing yet.
Nothing.
We got a couple.
A couple first-time homebuyers. How about repeat buyers? Anybody that's looking to buy maybe a second or their third home?
We got a couple of those online too.
Nice, great. So even repeat buyers can always learn different things. There's a lot of terminology involved with the home buying process, and we'll cover through that, and hopefully it's a good refresher and help you with the next time that you go through the process again. And then lastly, is there anybody here actually that's interested in refinancing, that currently owns a home but wants to to get a little bit more information on refinancing.
I would. That was the direct chat.
All right, great. So we'll have a little bit, we'll just talk briefly about refinancing. The majority of the focus is going to be on the home buying process, but we'll have a little section where we'll actually go through the refinancing process a little bit as well for those people that may be interested. All right. So this is kind of our agenda for the day. We'll talk about some initial considerations on how to prepare to become a home buyer. Kind of the steps that you'll need to really go through and consider to make you as best prepared as possible. We're going to go through a lot of loans, the various type of loans, the terms, terminology, definitions, and there's a lot of them with the mortgage process. There's home buying, and you'll hear them all thrown out from both your realtor side and mortgage officer side. So it's really good to familiarize yourself with it so that you understand, and how they're communicating with you and whatnot. And then again, we'll talk about refinancing briefly. We'll have a little bit of a section on that. We'll talk about agents, which are your realtors, the local market. So we'll talk both Fort Collins and the Denver area. We'll have a few sections on that, and just kind of the expectations of the entire process. And so that's kind of what we'll look forward to today. All right. Okay, so starting off with some initial considerations that you want to think about. And we kind of advise that you really start that process about 6 months before you're really looking to purchase, so that you can get yourself organized, get everything prepared ahead of time, and kind of have a plan of action. So you really want to start the process about 6 months in advance of when you would actually move in. The first decision to consider is if you really actually want to become a homeowner. There's absolutely a lot of advantages to owning a home, but there's also a lot of responsibilities, and ownership is not right for everyone. One advantage to renting is being able to actually move easier, such as a new career opportunity or a job relocation. When you're renting, you can easily pick up your stuff and move to a new location. You don't have to worry about putting your market up or your house up on the market and listing it for sale and having to deal with that. You can just easily pick up and move. Now, when you own a home, you are responsible for a lot of things with that home, especially like the repair and maintenance of the home. And a lot of people don't always realize that, when they're busy saving up the down payment, that they also need to think about all the repairs and maintenance that comes after you purchase that home too. You have to think about those things that are going to come out of pocket as well. And if you're really ready for taking on that type of maintenance, constant maintenance into your home to keep it updated. I have colleagues who rent, and while I'm actually out mowing the lawn and they're out off on their weekend adventures, I'm stuck at home. I have to make sure that my garden is tended to, and my lawn looks good, and so it takes up a lot of time, especially on those weekends. And then you have the people that are out looking to do the fun things. So you have to also consider that. But on the other hand, I have a great yard for my kids to play in and for them to enjoy. Where living in an apartment or renting, you don't always necessarily have that. Another thing, if like those major type of repairs, if the water heater goes out, you have to pay for it and pay for it now. You can't call your landlord to take care of it for you. You have to actually be responsible for it. Also, if picking your paint colors, if you want your house to be yellow and your landlord says no, you can't change it to a yellow color. But if you own it, you can change it to yellow. If you want a purple door, you can change your purple door. Unless your homeowners association says you can't, because they might have a say in it too. But we'll save that, talk about the homeowners association later. I do want to kind of tell another little story of mine. When I first bought my house, it was 2 weeks after I moved in, and I had a large delivery where I needed to prop open the screen door. And you know how you can kind of prop it up at the top. Well, I kept it open, got the stuff moved in, and I forgot that I left it open. And then by the afternoon, a large windstorm came through and blew the screen door completely off the frame. And so I had to fix that myself. And well, I had to call a repairman to come put it back in the frame, a new screen door. So 2 weeks later, after I bought the house, $800 right out of my pocket. So it is tough, you know, and those are the type of things that you have to consider that, you know, that are just going to come up as part of being a homeowner. And then, you know, that was in the fall, and then come springtime, my air conditioning went out, or I had to get a new part to replace it, which ended up costing another $1,500 just on the air conditioning. So, you know, those are the type of issues that you have to think about when becoming a homeowner that you don't have to worry about when you're a renter. All right. However, homeownership is a source of wealth for many Americans, and it's a lot of, you know, how a lot of people build their net worth, and, you know, through increasing home values and paying down your mortgage, you know, that becomes really a lot of families' nest egg that they can retire with and that they pass on to their kids. And so it really is the largest source of wealth for a lot of Americans. But the main thing is just know yourself and your abilities, both financially, with maintenance, and then just think carefully before jumping into the ownership adventure. Besides the emotional considerations, there are several financial things to consider before starting your search for the perfect house. Now, excuse me, so a lot of people that I come across always may think that they have to put 20% down to purchase a home. And it's just not the case anymore. In the past, there were times where, you know, you had to come with a full 20% down. But there are programs now that are available. Whereas first-time home buyers, you can put as little as 3% down towards the purchase. There's also grants available from the state of Colorado that can give you down payment assistance and also help with closing costs. So coming up with 20% down is not really the case anymore. But you know, and that could really become an overwhelming figure for a lot of people. And we'll go through some of the different loan programs here shortly. But you know, it's still even 5%, you know, towards the purchase of a new home, especially in the Colorado area where we're looking at $400,000, $500,000 home values. You know, it is a pretty significant amount. And then you throw in closing costs, and then all of those, you know, maintenance issues that may come up. It is a pretty substantial amount that you have to think about. So, you know, when preparing yourself, you know, definitely take all of that into consideration. So another great idea in that 6-month period to get prepared is to check your credit report and check your credit scores and kind of see where you're at. Doing it 6 months in advance is really going to allow you to see what's on your credit report, see if there's any issues on there that's holding your credit score back, and it'll give you time to resolve those problems. Because the higher your credit score, the more beneficial it is to you, because you're going to qualify for a higher rate and save you a ton of money over time. So yes, doing that 6 months out and preparing yourself for when you're really ready to start that mortgage process is really the best way to go about it. But yeah, you may even in that time frame be able to raise your score again, so it's going to help with interest rate and other expenses. So that's definitely a good place to start. Another figure to know is your debt ratio, and we just talked about it here. And the debt ratio is your monthly debt payments divided by your gross monthly income, and it comes up with a percentage. So most lenders are going to look to try to keep you under that 40%. Maybe cases, certain circumstances that allow you to go above that, but that 40% is really what's ideal. You want to try to keep it under that. So kind of going back to how that's calculated, those debt payments would include, any existing mortgage that you may have, vehicle loans, credit cards, student loans, really anything that's going to show up on your credit report is what's going to be factored into that debt ratio. And, items such as your electricity bill, your phone bill, that's not included. It's just really what's showing up on your credit report as far as loans and credit cards. Now, if your ratio is above 40%, it will become more challenging to get a mortgage. Because again, lenders want to make sure that you can afford your monthly mortgage payments. So they may charge you a premium for having a higher DTI or debt to income ratio. So you may need to focus on paying down some of that debt to keep that ratio as low as possible. So know your budget, know kind of what you can afford, and I think that's a good way to gauge how much of a good mortgage payment you can actually afford. And of course, be honest with yourself. If you're seeing that your debt ratio can only really allow for a $2,000 mortgage payment, well, you don't want to start shopping for homes that are in the $3,000 monthly range. You want to be honest with yourself and keep that reasonable. Because you may have heard the term being house rich but cash poor, meaning you've got this big, huge, fancy house that you're paying a ton of money for every month. However, you don't have any money to do anything else. You're just stuck with that large monthly mortgage payment, and and that's no fun either. And getting into that situation, it's just really it's not beneficial, and it really shouldn't be what home ownership is all about. All right. So besides examining the emotional side of becoming a homeowner and running the numbers around your budget, debt ratio, and down payment options, you'll want to look at the actual amount of a monthly mortgage payment. And this slide is great because it kind of compares the average rent, and it's actually shown in Denver versus a mortgage. Now I know that the homes here in Colorado can be expensive, but you may be surprised that home ownership can fit into your budget. Again, here's a comparison of renting and owning in the Denver market. And kind of going through this really quick, as you can see, median rent for a 2-bedroom apartment in Denver this past February was $2,250, which is probably even higher now. I mean, it continues to escalate. And then median condo sales were approximately $400,000. So assuming a 4% interest rate with a 5% down payment, your payment is shown on basically a $380,000 mortgage. So it's after your $20,000 or 5% down payment. So your mortgage would be $380,000. And so, yeah, you can see $2,250 being your rent, renter's insurance, so a total of $2,275. On average is about what you would pay in the Denver area. I can't imagine Fort Collins being too much far behind than that. But here shows a mortgage itself. Actually, I think this figure up here needs to be updated. But as you can see, the principal and interest on the new mortgage is just the loan payment itself, a little over $1,800. And these are your property taxes that you'll pay to the county, whichever county you live in, which is included into your monthly payment. Your homeowner's insurance also included, and then mortgage insurance. And we'll talk about that a little bit later, but that's also included in your monthly payment. And here you can see that, the monthly mortgage payment actually comes out to a little bit less than what you're actually paying in rent. So yeah, you can see where homeownership can become more beneficial than paying that rent. And plus, as you're making those payments, you're building more equity in your property, because a lot of that is just going to go down to pay down your loan. So as your home value goes up, your loan balance is going to go down, and you're going to have more equity. Whereas where you're renting, there is no equity. You don't have that luxury. All right. So this example doesn't include utility payments either, which is another consideration. If your current rental includes trash, electricity, cable, that's just going to make the figure even go higher. So another thing to consider. But from this, I hope that you're encouraged that home ownership is possible, and you can see that it is possible as opposed to renting. And we'll look more closely at the different parts of the mortgage payment itself in just a minute. All right, so I'm going to take a break. It's Stephen's turn. He's going to talk to you about if your credit actually matters.
Okay. Hello, everybody. I'm Stephen Lytle. I'm also a mortgage loan originator with Canvas Credit Union, just like Kevin. And I'm going to be reading some scripts here that were written by somebody else, so I will do my best not to butcher them and make sure I'm getting all this technology working properly here. Okay. So, and of course, just like we can, any questions you guys have, either here in person, raise your hand, or online at home, just throw it in the chat and we'll get those questions answered for you. All right, does your credit matter? Yes, absolutely it does. Your credit score impacts many parts of your financial life, including your home purchase. Many lenders require your score to be above 680, and improving your score will lower the interest rate you pay on your loan. Even a 0.25% difference in your mortgage rate can equal thousands of dollars over the life of your loan. So put that into real numbers. On a $300,000 mortgage, the difference between a 5.25 rate compared to a 5% interest rate is $16,615. So that's the amount of interest that you repay over the life of the loan. So just a 0.25% difference is over $16,000 that you pay more for the higher rate. The difference goes up even more if you increase the loan amount or the interest rate more than 0.25%. So if your rate is 0.5 higher, of course, that number that you repay is going to be even higher. What affects my credit score? So you've got the nice little pie chart there that shows how kind of each thing is weighed as they score your credit. I think that's pretty self-explanatory, but there are many factors that can affect your credit score, and some have a larger impact than others. In the world of credit, past behavior is the best predictor of future behavior. If you were late on your payments before, you're likely going to be late on payments again. That's how they look at it. So how you handle your loans, you already have, influences the score, which can influence being approved for your home loan. Things that don't impact your credit score, but that will be part of getting approved, include your debt ratio, income, length of residency, and length of employment. We were talking earlier with one of the people here in the room. You can get a loan immediately after you graduate from school. You don't necessarily have to have a 2-year employment history, but in general, we are going to be looking at least 2 years back at your employment and other things like that. So your history, what you've done up to this point, definitely is considered. These aren't a part of your credit score, but those are taken into account by an underwriter when determining, and please let me scroll down on my script here, to account by underwriter, when determining if they will approve the loan. So like we're saying, credit score is a big part of it, but there are other things that underwriter are going to be looking at, and we can discuss those further too if you like. Okay, so getting a copy of your credit report. We definitely recommend that you do this. It's good to know where you stand before you actually get into the whole process, because you may have some work that needs to be done. So you can access a free report from each of the 3 major credit bureaus. The report does not include your actual score, but you can pay a small fee, generally around $15, to get your score. Many credit card companies, banks, credit unions now offer your credit score as an added benefit, but they do not provide you with an actual report. Canvas Credit Union, for example, gives you a free credit score once every 3 months through our online banking portal. I think you can get one just about anywhere. If you have a credit card, you probably have access to a free score. Something that this doesn't mention is that the credit score you get on your own is not necessarily the same as the score that we are going to get when we pull your credit. In most cases, the score we get is going to be a little bit lower. So if you're kind of near the borderline of 680 or lower, it's definitely should be a red flag for you that you take a look at your report and see if there's, talk to a credit expert like one of us and see if there's some things that you can do to try and get that score up. You may want to consider getting all 3 reports at once if you've never compared them to one another, or you may want to consider pulling one every 4 months from the different bureaus. Humans are involved in the process of credit reporting, so there can be errors. It's important to review your reports before looking into buying a home because fixing errors may take time. It's not an easy process if you do find an error. There's a whole bunch of steps you have to go through to try to get that corrected. Right here, annualcreditreport.com, that is the website. Every American is allowed 1 free credit report every 12 months. So you can go there to get started, and they'll give you a copy of all 3 reports at no charge. And if you want to get your scores also, you can pay a little bit extra for those. But I would highly recommend using that if you have not yet. Loan terms, terminologies, okay, all this good stuff. Let's do another poll. All right, so we have all our favorite acronyms that we use every day, all day long, so we know them very readily, but for you guys, LTV, DTI, MIP, PMI, PITI, Escrow, and points. How many people here and at home or online have heard of 3 of these? We got one. She's an expert. Okay, how about, does anyone know all 7? All right, there's one. Anybody in the chat, does anybody know any of them? Okay, we'll go through them all. Okay, so we're going to jump into a bunch of definitions, and I want to remind you to ask questions here in the room or use the chat function and submit any questions or request clarification as we go through the next several slides. Loans, loans, loans. So when you get a loan to buy a home, it's called a mortgage. One of the reasons home ownership is possible for so many people is that there are different kinds of mortgages for different situations and borrowers. So we'll talk through some differences between these types of mortgages. FHA, VA, and USDA loans are all government-insured loans. They're designed to help make home ownership possible for specific people or in specific locations. FHA loans are designed for first-time buyers, people with lower down payment, or people with lower credit scores. Most FHA loans will require mortgage insurance to be included in the payment for as long as you have the loan. That's an important one to remember. If you do go with an FHA loan, it will have mortgage insurance for the entire time you have that loan. VA loans are only offered to veterans, and they have many attractive benefits, including lower closing costs, no down payment requirement, no mortgage insurance, lower credit scores allowed, lower interest rates, and extra safety standards. If you are a veteran, you need to make sure you look into this option. Let your loan officer know, I'm a veteran, I do qualify for the VA benefit. Home loans, they're a great product. I love doing them. One of my favorite things to do. USDA loans are only given for purchases in specific areas, targeting rural areas that may be slower to develop than more urban settings. A conventional mortgage is offered by a private lender. It will likely have higher credit score expectations, but can be more flexible than a government loan. Conventional loans are where the 20% down idea comes into play because you can avoid adding mortgage insurance to a conventional loan by having that much of a down payment. So let's say that again. The reason people talk about putting 20% down on a home is because they can avoid having mortgage insurance, but this is not required. And I think we see more and more often people have less than 20% down, and there's absolutely nothing wrong with that. Especially with the home values in our area. We haven't gone over the median home values yet, but they're a bit shocking. And when you see how much a home costs, trying to get 20% of that value is going to be very difficult. We have questions.
I was wondering, the spring just went off,
Oh.
but, it's
I think
pushing.
I'm bumping the cord.
I was wondering if you could give an example of like how much you would save doing the conventional versus FHA if you have to pay like mortgage insurance. How much is mortgage insurance over like that 30-year period? Is that like
Ooh.
$20,000 or?
Try to make me do math in my
Oh, I don't know. I
head.
didn't know if you had an example because you were giving all the number examples, so.
Yeah, I think FHA mortgage insurance is a little more expensive than a conventional mortgage insurance. And they're based off of the amount of the loan and also the percentage of the down payment. So I'm just throwing numbers out here, they may not be accurate, but just to give you an example, say $300,000 loan and you're doing 5% down. FHA might be $200 per month for the mortgage insurance, whereas conventional might be $150. In general, conventional mortgage insurance is going to be less, but the additional benefit you get there is you can actually cancel your mortgage insurance once you pay your loan balance down to a certain point, usually under 80% of what the home value was. Whereas FHA, you pay that for the full 30 years, unless of course you refinance or sell the home.
Yeah, so if you keep that, mortgage, or you keep that home for 30 years, I mean, you're talking tens of thousands of dollars that you're gonna pay in mortgage insurance for an FHA mortgage versus a conventional.
$200 a month over 360 months.
Yeah,
I can't do that in my head, but it's a
right,
lot.
yeah.
We're not trying to discourage you from FHA in any way. Just important to know that it does have that one stipulation that it's for the life of the loan, whereas conventional would not be. Where do we leave off here? Jumbo mortgages are loans for higher amounts of money, and the definition of that amount is determined by geography. If you are borrowing money more than the defined limit in your area, then you will need a jumbo loan. In 2022, for most Colorado counties, that amount is $647,000 and $200, which includes Larimer and Weld counties. However, Denver is higher at $684,250 and Boulder $747,500. Jeez. We'll get to it in the median home prices too. You'll see Boulder it's crazy. Anyway, jumbo loans may require a higher down payment or proof that you have savings set aside. Jumbo loans generally have a little harder underwriting restrictions. So you may have to have 2 months worth of payments set aside somewhere in your bank account in addition to the down payment, things like that. Over the years, mortgage lenders have done creative things to help people get into home ownership. Graduated payments, second mortgages to cover down payment, and first-time buyer programs are some examples. The 100% home mortgage is a loan developed by Canvas for those who do not want to put any money down and instead plan to finance the entire purchase. That is something that we offer only at Canvas and 0 down. It's a real thing. I didn't believe it until I started working here, but it definitely works for some people. Having a great mortgage consultant is really helpful because of all the different loan types that exist. Obviously, you want to work with someone who knows what they're doing.
Couple questions.
All right.
Go ahead first.
So on your 100% loan, how do you do your mortgage insurance with that?
Just like any other conventional loan, it's, it'll be based off the size of the loan, and if they're not doing any down payment, they can do 1 or 2% down.
So it's a conventional loan then?
Yeah, it's a conventional loan. It's a Canvas portfolio loan. Doesn't go through Fannie Mae or Freddie Mac. So we keep it, and we get to make up our own underwriting guidelines for it as well. So can get some exceptions, different rules on there too, but in general, it's about the same as a conventional.
Do you service that loan?
Mm-hmm.
Okay.
Yeah, we service all of our loans, regardless if they're conventional or, well, not FHA. Sorry, we don't do the government loans. So no FHA, but we do originate them and underwrite them as well.
I think you may have mentioned this, but just in case to loop around, do jumbo loans require a 20% down payment? Is the
They do
question
not.
online.
It's encouraged mortgage insurance on a jumbo loan because mortgage insurance is based off of the size of the loan. The bigger the loan, the bigger the mortgage insurance payment. So if you can do 20%, great. If you're not required to, I believe believe our jumbo is 5% minimum down. So yeah, it's definitely possible.
Is that pretty standard for loans, or like that the minimum is 5%?
Most conventional loans, yes, 5% be the minimum. And then there's a couple special programs that go to 3% or FHA's 3.5 or 0 down on Canvas.
So you'll like this next question, and thank you to all of those online asking questions. Is there a catch with the 100% home loan through Canvas? Sounds too good to be true.
I've heard that before, yeah. No catches. The credit score requirement is a little bit higher than a regular conventional loan. The mortgage insurance premium is a little bit higher than conventional, but in general, no catches. You have to be a first-time buyer, and you can't own any other real estate at the time of the purchase. But all you have.
No, actually, not to be a first time.
Oh, you can't own any real estate at the time, right? You don't have to be a first time.
And I would say the trade-off is probably just that it has a higher interest rate because it's a full 100% financing, versus you actually putting a down payment down on like a conventional mortgage. So the interest rate is going to be higher, but no, it's a great program.
Originated several of them, and they all went really well.
Yeah.
And if folks wanted more information about that, would it be your contact information or a link to a webpage or?
Yeah, absolutely. Either Kevin or I think you'll be putting our emails up at the end.
I was going to say, we can definitely include post-event follow-up with the best way to learn more about that specific
And we can
loan.
send out the slideshow to anybody that's interested. That provides our contact information. Yeah,
Perfect.
so feel free to
Yeah, and Canvas.org also has information on all of our loan programs as well.
Awesome. I think we can keep rocking and rolling.
Okay, terms and terminologies. We'll go through all of our acronyms now. I hope that learning about different loan types helps you realize that there are lots of options when it comes to getting a mortgage. There are also lots of acronyms for you to understand. So before we jump into all these initials, let's talk about the term of a mortgage, which is how long it will last. Your common terms, 10, 15, 20, 30, most people are going to be in the 30s. Awesome if you can get a shorter term, it just means you pay it off faster, which means you earn equity faster. But shorter the term, the larger your monthly payments. Most people will be in that 30. 400K, oh yeah, so you can illustrate that right there with a higher payment on 15-year. All the fun terminology. So where'd I leave off? Okay, so the higher the amount being borrowed, the most common loan payment or loan term is 30 years. For instance, the monthly payment for a $400,000 loan for 30 years is about $2,500, but it jumps to around $3,500 if the term is 15 years. Most people need the price break for a longer term. One moment. So switching from terms to terminology, let's define some common acronyms. Loan to value is a ratio comparing how much you borrow divided by how much the home is worth. So lower is better. LTV would be the opposite of down payment. If you're putting 20% down, your LTV is 80%. If you're putting 25% down, your LTV is 75%. So on and so forth. A lender is more comfortable giving you a loan that is lower compared to the value of the home. So obviously, the lower the LTV or higher the down payment, the better your loan terms would be. DTI, or debt to income, is another ratio that lenders like to see low. Kevin and I have gone over, we suggest that you try to be below 40% on this number, and that is the total of your monthly debt payments divided by your gross monthly income. One question.
Yeah, before you guys were kind of mentioning, like, if you're kind of expecting a change in your income, does your past, like, history factor into the debt to income, or is it just like the expected income, I guess?
So what your income is at the time you apply.
Okay,
So, yeah, if you were making $12 an hour last year, but you're making $50 an hour this year, we're going to use the 50. But we talked a little bit before the show started that you could even use an offer letter. So if you are not currently making that amount, but you have an offer letter with no conditions on it, and it says you're gonna make this much starting on 3 weeks from now, we can use that at least to get the process started. But yes, whatever your current income is.
Then follow-up from online, are interest rates on a 15-year loan generally lower than a 30-year loan term?
Yes, almost always. So yeah, shorter the term, lower the rate, higher the payment in general. Okay, let's go next to PITI. So this is the fast way of us saying your total mortgage payment. PITI is principal, interest, taxes, and insurance. So we pay back our loan with the principal and interest portion each month, but you may not have been expecting to pay 1/12 of your property taxes and 1/12 of your homeowner's insurance each month as well. The reason those amounts are collected is because it can be difficult for a homeowner to come up with the full amount due annually for those expenses. By collecting a little bit all year long, then the bill can be paid on time. So whoever is receiving your loan payment will also be collecting and then paying your property taxes and insurance on your behalf. The money they collect is kept in an escrow account, and once a year it is evaluated and your monthly payment may change so that the needed amount is available. So you probably heard escrow before, and that's usually what they're referring to when they say escrow. It's this account. You pay 1/12 of your property taxes and your homeowner's insurance into that account every month. It's part of your monthly mortgage payment. And it sits there in this escrow account until your lender pays it once or twice a year when they become due. Your mortgage payment, the principal and interest part, cannot change. It is going to be the same from day one all the way till the loan is finished. But the taxes and insurance could change. And taxes don't go up or don't go down, they always go up. So your payment can go higher.
For those payments, is that due once a month? And is it possible to like split it up so you can actually have it like if you have 2 paychecks a month or something, can you split it up that way? Or is it all sort of lump sum like at the end of the month?
Yeah, it is due once a month on the first of every month, and then you have a 15-day grace period until the 15th of every month to make that payment. And after that, it will be late, and there will be a late fee. You can set it up. It kind of varies from lender to lender. In general, if you made, say, a half payment at the first part of the month, and then the second half in the second part of the month, the first half, it's not a full monthly payment, so it just kind of sits there in what they call an impound account. We don't have to get that specific, but they will not consider your payment made until they receive the full amount. Does that make sense?
Yep.
There are programs out there called like an equity accelerator where they have you make it's payments every 2 weeks instead of once a month. And by making 36 payments instead of 12, no, that's not right.
Yeah.
Anyway.
26.
I told you I don't do math in my head. So you end up making one full monthly payment extra every year, and that accelerates how fast you pay down your loan, and can actually finish paying your loan like 7 years faster on a 30-year loan just by making one extra payment per year. So that's definitely something you can take advantage of. If you have the extra money, I would recommend it. All right, a couple other things you may have heard referenced are points and fees. Oh wait, no, I'm sorry, I skipped one. Yeah, okay.
You're at PMI.
PMI and MIP. So PMI, MIP, they're the same thing. Private mortgage insurance or mortgage insurance premium. So that is when you put less than 20% down, you will automatically have PMI. We usually just call it MI in the industry. So if you hear PMI, MI, MIP, all the same thing. But in general, is required on any loan with less than 20% down, other than VA loans. Where are we? Oh, so it's paid each month on some types of loans. It protects the lender if you don't pay your loan back. So homeowners insurance, which you are required to have on all loans, it protects you from things like fire or hail. Private mortgage insurance protects the lender. So you really don't get any benefit from it, but you still have to pay for it. A couple other things you may have heard referenced are the points and fees. So it is possible to pay extra upfront to get a lower interest rate. That is called points, or you may hear discount points, same thing. There are always fees that are part of the mortgage process. Some are paid by the seller, some are paid by the buyer, and some take place early in the process and some at the end of closing. Some can be included in the loan amount, some must be paid out of pocket. All of those variables are why you want a trusted mortgage advisor helping you through the process. Any questions on that one? Maybe?
Yes. We have a couple different chats going, so I gotta get
Okay.
back to the right one. But back to DTI, if you've been promoted and are making more money than the previous 2 years when beginning the home buying process, will that be taken into account when the bank or credit union is determining your DTI?
Absolutely. What your income is at the time that you apply. And if you get a raise during the process, let us know because that will be counted also.
Good question.
Okay. Next one. Mortgage payment anatomy. So what is included in the mortgage payment? We went over PITI, principal, interest, taxes, and insurance. And then there could also be MI, mortgage insurance, if you have less than 30% down. So a quick review of what you need to include when examining how much your monthly mortgage payments will be. It is your PITI, plus there may be mortgage insurance. That is what you pay each month. Just like when you rent, you may also have HOA fees, and you will need to pay for utilities. Those payments are separate from the amount you send to your lender for your mortgage payment. I think that's important to know, especially if you're looking at purchasing a condo or a townhome. They usually have HOA fees, which are not included in your mortgage payment, but those can be $300, $400, $500 a month on top of your mortgage payment. So if you're looking at condos and townhomes, definitely consider that in your budgeting. And I think, is it time for Kevin to take back over?
I think so.
All right.
All right.
Kevin's gonna talk to you guys about refinance.
All right, before we do that, do we have any other questions about all those fun loan terms?
We're doing good online.
Curious, how common are HOAs? You said condos have a higher rate, but like, is this something in 90% of housing, or is it variable? Based
Condos
on
and
where you are?
townhomes always have
Okay.
HOA, and they're gonna be pretty expensive, hundreds of dollars a month. And then for a single family home, it depends on the neighborhood. And most newer neighborhoods all have HOAs. Mine is $150 a year, so it's almost nothing, but you can find ones, especially the newer, what are they called? Metro District.
District.
Yeah, Metro District actually has a separate tax added onto that as well, as included in the property tax. That can be very expensive, but you also get amenities that come along with that. So you are paying for something, a pool or golf course or clubhouse, gym, any of those things can be included in that HOA fee.
To tack on to that, would you generally suggest buying in a place that has, like buying in a neighborhood that has an HOA? Because I know that can affect the value of your house, right? If the neighbors aren't keeping up their property, does it really matter
That's
that
kind of what
much?
the HOA is there to protect you, I guess, against, you know, to make sure that all the houses are kind of uniform and in line, up, and, you know, kept up to date. So a lot of people like that. They like that oversight that those communities have. Others, they don't. They don't like that oversight. They want to be able to do whatever they want with their house. And
Would it really affect you much when you're trying to sell later after let's say you've been there for 5 years or whatever, it's still a crappy neighborhood. Like, does it really affect anything?
So I have a
I mean,
story.
it can. I'll let Nancy take this.
So I live in a neighborhood that does not have an HOA, and my neighbor has had tarps on his roof for 6 years. He does not have a roof, he has tarps on his roof, and he's had it that way for more than 6 years.
It's your,
So if I was in an HOA, you can be pretty darn sure that that wasn't gonna happen. By the same token, I can paint my house any color I want to, I can have a clothesline, I can have a garden, I can, so it's a trade-off, and people feel strongly one way or another about that. The biggest thing I can do is suggest is if you're going to get into a neighborhood with an HOA, that you read the HOA documents very carefully, very early in the process, because you won't win. If it comes up you against the HOA, you won't win.
Yeah.
So read them early and make sure you can live with what they say. And then I know personalities, just like Kevin was saying, personalities that want that HOA. They want
Yeah.
that.
Sure.
And very few people want HOAs, but it's not going to affect the value of your home. The value is going to be determined by the neighborhood either way.
Mhm.
But there's a lot of older neighborhoods that don't have HOAs, and they're nice neighborhoods.
And people desire those just as much, it's just really,
Yeah.
it comes down to the personality of the person who's going to buy that home, for sure. But yeah, reading the HOA docs, absolutely important. I had a couple that fell in love with this townhome. They didn't read the HOA docs, and then just a couple of days before closing, they found out that the community only allowed dogs under 25 pounds. And they had a dog that was a bigger dog. They had a 50-pound dog, and they didn't want to get rid of the dog. So they backed completely out of the deal. And it was unfortunate that, of course, their dog was more important than the townhome.
And that late in the game, you're going to lose your earnest money.
Yeah, and they ended up losing their earnest money because of it. So yeah, it was a tough situation, but yeah, if you're seeing a house that's with the HOA, very important to understand it right in front.
Another question from
Sure.
online, somewhat less related, but still relevant. Does Canvas offer land loans or construction loans?
We do not offer either. Usually those fall under specialized lenders that specialize in those type of things. We're primarily a conventional mortgage lender who will only lend, on an existing residential home. But there are lenders out there, and you can do a Google search for them, and there are some that are local here as well. All right. Are we good?
I think we're good.
All right. So for those that were possibly interested in refinancing that are current homeowners that look to actually change the terms of their existing mortgage, we'll talk about refinancing considerations here. So it's basically if you're already a homeowner, and so we'll talk about whether refinancing your loan into a new loan would become beneficial. So we'll just go through some of these points pretty briefly. So basically there are two fundamental reasons that people will refinance. And one is there are financial considerations like lowering your monthly payment or withdrawing cash from the equity that you built up in the home. Those are really the two primary factors that will lead you to want to refinance. The others may be like personal reasons, such as like divorce, where a new loan has to be created to remove the ex-spouse from the deed or from the mortgage of the home. So those cases, of course, will come up. And so, yeah, the new loan must be created to reflect who individually owns the home. Here are some of the financial situations where people think about refinancing their loan. Perhaps loan rates have dropped since taking out the loan. What we experienced over the past couple of years, we really had record low interest rates. So we went through a whole refinance boom over the past couple of years because we were seeing rates under 3%. So people that, 5, 10 years ago that were buying their houses at 5, 6, 7% even, now that rates are, under 3%, I mean, they're going to save tens of thousands of dollars to refinance their loan at that lower rate. And they're going to lower their monthly payment. So that's the primary reason why some people want to refinance. Or maybe you've been paying up for a while and a new loan would lower your monthly payment. So again, some people want to simplify their debt position through consolidation, or perhaps they had an adjustable rate loan and want to change that to a fixed rate. Kind of going back to those different loan terms, there was a question about the 15-year term. So say you bought your house at, with a $300,000 loan, but now you paid it down to $150,000. Well, it may be beneficial to actually shorten the term also. to go from a 30-year term to a 15-year term. So you're going to lower your interest rate even further and reduce that term and continue to build up even more equity in the property and pay it off much sooner. So a lot of people will do that, is to reduce that loan term. Another reason that people would like to refinance is if you're currently paying mortgage insurance. So we talked about the FHA mortgage, where you pay mortgage insurance through the entire life of the loan. Whereas with a conventional mortgage, you can actually remove mortgage insurance. So you can refinance from an FHA to a conventional mortgage, provided that you have that 20% in equity already built up. But once you refinance, you can get perhaps a lower rate. You can remove that mortgage insurance, so it becomes truly beneficial for you. All right, and then lastly, or you may want to take advantage of your ownership position to withdraw funds to use for another purpose. That's another big refinance reason. It's called a cash out refinance. So again, say you paid your mortgage down to the 150, but you want to use, you need to use 50,000 to go buy a brand new RV. Well, you can refinance your home and then take out that 50,000, and then the lender will give you that 50,000, and you can use that 50,000 to purchase whatever you like. So a lot of people do that, or you can use it for debt consolidation. A lot of people pay off their credit cards, any equity loans that they have, auto loans, right? Home improvement is another big one. They'll pull out that cash to replace their roof, do home improvements, upgrade their house. So that's definitely another large reason to refinance. And then for those basing the decision to refinance on financial considerations, the main question regarding whether it's wise to refinance is, will you be in the home past the break-even point to cover the cost of refinancing? So how much are you going to save each month, and how long you will need to stay in the home at that lower monthly cost before you recover the cost associated with the refinance? What that basically means is, when you refinance your home, you're going to pay a set of closing costs, probably both from your lender and from the title company that's going to perform the actual closing. And those can add up to thousands of dollars. So you're going to have those costs added to your loan right up front. So you have to make sure that reducing your interest rate is going to recover, and you'll save enough money to overcome those closing costs. So that's really what that's talking about there. Excuse me. All right, a couple of other things to consider.
Another question.
Oh,
Sorry,
sure.
I guess I could have just called it out, but
Okay.
I mean, is that like a crazy amount of time? I mean, you said you want to make sure you stay long enough. Is it like years?
It
That
depends.
take?
It could be, yes.
Could?
It really depends on how much you're reducing your interest rate to how much your costs were to actually do the refinance. And that's where the mortgage loan officer, we can sort of calculate that for you, give you an idea of, okay, well, if you refinance now at this rate, it's going to take you 2.5 years to overcome those closing costs. And then after that 2.5 years, that's when you'll start experiencing those savings. But yeah, I mean, it can be, if you're only reducing your interest rate by 1/8%, I mean, it can take 10, 15 years for you to overcome those costs. So that's why, you have to make sure it's a substantial change in interest. All right. Okay, so a couple of other things to consider before refinance is whether your credit score or your income has changed. If either has dropped, you may not qualify for that refinance either. So that's certainly something to think about. Or by having your credit score drop, you might not qualify for the same low rates, maybe much higher. Also, if a second mortgage is in place, that will need to be considered in the refinance process also. A second mortgage is basically like, it's just that, you get a second mortgage against the equity of your property. That also many times has to be included. For most people, the major issue is that, again, will they be staying in that home long enough to benefit from the monthly cost savings? So that's really, what the main factor is. when it comes down to refinancing. Sorry, that was kind of duplicated in the script there. Yeah, that's pretty much it about refinancing. A lot of the different reasons that would initiate somebody to want to refinance. Do we have any questions about that?
You're looking good online.
All right. Well, let's move along. This is a home buying class, so let's talk about home buying. All right. Why use an agent? And again, or a realtor. And I think this is probably one of the, besides picking your lender, it's also going to be the largest choice that you'll make during that process leading up to actually finding your house. Finding the right realtor is crucial in the whole process. So we'll talk about briefly why you want to consider working with a realtor. The process of home buying can be complicated. A lot of the contracts that you're going to be working through, the negotiations with sellers, that's why you need a professional. You have to have an expert to be able to go through and to negotiate it properly. You don't want to be out there just working kind of blind and you just learned about all the options related to lending, and the process of finding a good property to purchase can also be confusing. Real estate professionals or realtors know the process. They know what dangers to watch for, how to understand confusing documents, and how to negotiate important items, and just as important, which items not to fuss about. There are a couple of different ways you can use a realtor, so be sure you understand the relationship that they are proposing. You want them to represent your best interests. Some specialize in a particular market area or price point, and there are lots of realtors with lots of different styles. Talk to your friends, interview several of them, and find someone you are comfortable with. Ask how many homes they sell each year, how long they've been in business, is it their full-time job, and if they have any references. It may be nice that your cousin just got into real estate, and you want to, of course, support them, but this is a high-dollar decision. It's probably the largest financial decision you'll make in your life, and it can be stressful, and you want to make sure that you are working with the right person in that scenario. But yeah, I can't stress this enough, especially in this market now, where as a home buyer, you're going to compete against 20 different other offers that are being placed on every single home out there. And you want to make sure that your realtor has a good reputation, who knows the area, who knows many of the other realtors in the area, and can make those great negotiations and try to get your offer to stand above everybody else's. Especially when you're competing against cash offers, people that are making substantial down payments towards the home purchase, it's crucial. And if you're a regular home buyer and you only have 5% down, the sellers are going to see how much you're looking to put down towards a purchase. And if they're comparing your offer of 5% down versus somebody that's going to just pay cash and just get the process over with in 2 weeks without having to worry about the whole mortgage process, it's tough. It's really tough, and that's where your realtor comes into play. I was lucky enough where my realtor, he had a great reputation. He knows a lot of people. He's a CSU football alum, so people know him, and they want to work with him. And he actually was able to get my offer accepted over a cash offer, and just because of his name alone. And that's that's where it's really important, is to interview them, get references, check out their website, see their reviews. All right. Any questions about realtors?
Kevin, you might just point out that when you're buying, the seller pays that fee.
Yes, great point. Yeah, as she said, as a home buyer, you're not paying your realtor's commissions. It's always the seller. The seller pays for both their realtors and your realtor's commissions. Generally, it's 6% of the sales price that comes out of the seller's proceeds. But as a home buyer, you don't have to pay them anything. It's a completely free service to you. And that's why, absolutely, use one, you're not paying for it.
Um, Oh, sorry. An online question. Do
Sure.
mortgage loan originators work closely with a client's real estate agent once they have accepted an offer?
Yes, absolutely. We're all a team, and as soon as I get a contract, even before usually getting a contract, I'll find out who my buyer's agents are and reach out to them, and have open up conversations, because again, they may have to go through several attempts and several offers that they're placing on multiple homes. So I immediately want to open up that line of communication, let them know that I'm available, to help them. And yeah, and then so we're all on the same team through the entire process. Many times I'll even talk to the seller's agent. Once we get the contract and I know who that seller's agent is, I think a good prudent loan officer will reach out to the seller's agent too and let them know, hey, this is the situation. We've got them all qualified. They've done, we've already got all of their documentation. So we expect this to be a smooth process. So yeah, it's crucial that everybody communicates.
And if I may, what he just said, I've gotten more multiple offers accepted because the lender has contacted the seller's broker. It's a 2-minute conversation, but having them reach out to the seller's broker, that way they know that they're really qualified and to what level they're qualified.
Yeah, I think any prudent loan officer would do the same. Sure.
Thank you both. And thank you to the folks online for the questions. If you need further elaboration, just keep popping them in the chat.
Sure. All right, moving along. All right, so we're going to talk about what is happening with our local market here in Colorado, which is very interesting these days. But I'm going to kind of pose a question here for both people in the room and online. So we'll kind of see what you think about the current market conditions here in Colorado. Talk about the kind of real estate values and mortgage rates. Let's start with mortgage rates. So in 1980, the average interest rate on a mortgage loan was around 13%, which is crazy.
I did it too.
I know. Oh, man, that's
Me
a lot.
too, yeah.
That's a lot. What do you think it is now? So I'd love to see some people in the chat, and what do you ladies think? I know you probably know that. What do you guys think?
I don't know, 6?
Let's say like 7.
You got a 3% online.
I feel like it was that, but I don't know if it's that
Right.
low anymore.
Yeah, it was last year. We got down under 3%, and as soon as 2022 hit, they skyrocketed. So now we're between 5 and 6%. So we're getting back to levels that we haven't seen for 10 years. Yeah.
And is that expected to go up further
Yes.
as 2022
Yes.
progresses?
Yeah, they haven't, it's the Federal Reserve that kind of sets the interest rates, kind of industry-wide, not just for mortgages, but for auto loans and credit cards. They all kind of base their interest rates off Federal Reserve rate. And yeah, they haven't shown any signs of slowing down. So, and it's just amazing how quickly it happened too. Because we started off the year the low 3s, and then now we're at like 5.5, and it just jumped up within 5 months. They've increased that fast, and they'll continue throughout this year. And it's all just kind of in attempts to curb inflation. And so, yeah, I think by the end of the year, and this is just my own speculation, we'll probably see them above 6%, maybe even approaching 7%. So yeah, now's the time to really think about home buying and trying to get in at the lower interest rate, and before the housing values continue to skyrocket even higher. So, all right. Well, luckily they're not 13% though. I don't see that happening anytime soon. All right, in 2010, the average price of a home in Denver was $259,000. What do you think it is today, 12 years later? What would you guys guess?
450.
I was gonna say almost double.
600.
The average today is around 700,000.
In Denver. Denver.
And Nancy, I think that's even low, to be honest.
So I was researching numbers last night,
Yeah.
putting in everything that came out and that I could find.
I think.
And we have to, you know, some of the numbers are median and some of the numbers are average,
Yeah.
and that can throw things off. And then, I mean, you know, statistics, you can make them say whatever you want.
Yeah, you can find them from wherever.
And I hope there aren't any statistics majors in here.
We did get a 700,000 from online, so
Nice.
we had someone
Yeah.
guess it.
Yeah.
Well, they're looking it up. I think-
Yeah, when you're online, you can do that.
Yeah,
It's in the fives. It's around 565 is what last we heard. Was the median home price.
the median, right?
Median home
Yeah.
price in northern Colorado.
So this was Denver. So
Yeah,
Denver,
that's
yeah,
definitely
700,
Denver, yeah.
And it was
And Fort
average,
Collins.
that was average.
And Fort Collins isn't too terribly far behind.
No, it's not.
Yeah, it's getting close. All right, so thanks for getting some good guesses there. Over the last several years, there has been a great deal of interest in buying, particularly in the lower price points. But as a lot of people are really realizing, there's an extremely limited inventory. So we'll cover a couple of numbers that may be of interest. Okay, here's another good slide that I think is really interesting. And these go over the median sales prices. So this is a little bit different than the average. But real estate purchases in markets vary tremendously by location. Depending on where you live and what kind of house or condo or ranch you are trying to buy, the specific numbers will be different. Here are some general things you
Lost this screen
Oh.
here. I think it's that corner side.
Go ahead, and I'll probably start this.
Just need to click on that part.
Gotta love technology.
Our friend.
Any questions?
Oh, let's start over.
Okay, all right, back online here. We don't want to do the whole thing over again, so we'll just.
No, we were at the really depressing part.
All right. Let's see, where was I? Okay, so here are some general things that you consider about the situation on the Colorado Front Range. Again, location affects price, and you can see the different price points here. I do love this slide. It really gives a good comparison. As you can see, Greeley, the median home sales price here in April, so very recent, 452,000. Fort Collins, 620, and then Denver is 625. So you can see Fort Collins is not that far behind Denver whatsoever. And I read an article not too long ago that Greeley is actually the largest metropolitan, or the quickest and fastest growing metropolitan area in the United States. So yeah, Greeley is certainly expanding. There's a lot of people moving there, and a lot of it has to do is because it is a little more affordable than the rest of Colorado. And it's still in a closer location. And then Boulder, as you can see, 1.6, almost 1.7 million and that's the median. Median is supposed to take out the higher end homes, but that's an insane amount of money to buy a home in Boulder. And then Colorado Springs, 475. National average right now is at 428. So as you can see, Colorado is definitely on the higher side and becoming a very expensive state.
Back to refinancing.
Sure.
Question from online. For when interest rates come down again someday, in parentheses, hopefully, I just love that sentiment. Is there a certain amount of time you have had to held your mortgage in order to refinance?
6 months. Yep. So 6 months from the time that you purchase to the time that you can refinance.
Thank you.
So hopefully interest rates will come down sooner than later. We'll see. But the thing is, when you're buying a home at the higher rate now, you're buying it at 5-6%. Historically, rates do come in waves, and there will be a time where it will come back down. That's when you take advantage of it. Yes.
Is the median sale price like a common metric that you can find online for other cities and other places?
Mm-hmm. Sure. Yeah, just Google search that metropolitan area, median housing prices. Yeah, I think a lot of the realtor associations publish it in each area. They have really good reports that do publish this information.
And your realtor should be able to get you that information as well. And there's other homes. You can get a home for $450 in Fort Collins. It's going to maybe a fixer-upper, or it could be whatever, but you can get something under $5. Or you can go out to the outlying areas and get something for less.
And I do think these are based more on single-family dwelling
Yes.
as opposed to that condo market,
Yeah.
townhome market. So
Yeah.
there is a good price drop when you change that statistic.
Great point. All right. So yeah, as you can see, the difference between 50 miles between like Greeley and Boulder, it's all about the location, and how much pricing or how much home prices are going to change. So let's talk about inventory. It's certainly still low, especially in the lower price points. The $300,000, $400,000 homes are going to sell a lot quicker than the high-end homes. In Boulder, 1.7 million. It's just the nature of it, especially with first-time home buyers. They're going to seek those lower price points. A balanced market is around a 6-month supply. This means it would take about 6 months to sell every home that is listed at the time. We have a 1 or 2 month supply currently, probably even less. Some areas, Fort Collins, 10
There's
hours?
no months.
They probably have 10 hours. As soon as they're on the market, they've got 20 offers by that weekend easily. It's amazing. So yes, homes are selling quickly. Last number that we saw here was about an average of 13 days for Denver, and running about 30 to 40 days across the Front Range. Depending on the price point, there are multiple offers, and those offers can be well above the list price. All of these indications are on the seller's market. The rates are still low compared to past history, especially 13%, but they are increasing, like we talked about, and I can still continue to see those increasing well into this year, well into 2023. Currently, again, they're in the 5 to 6% range. 10 years ago, they were about 6 to 7, and 20 years ago, they were 8 to 9%. Hopefully, we don't see them get that high again, but you never know. The economy could swing that way. And all it does is when the interest rates go up, it makes your mortgage payment higher, and it reduces your ability to buy a higher price home, you know? And it's hard for home buyers because escalating home prices going up and interest rates going up makes the amount of the loan that you can afford less. So it's caught in a stuck spot or a hard spot there.
So do those interest rates still affect like a fixed mortgage if you already have one? Or like the adjustable?
No,
Or-
well, it doesn't affect the fixed.
But
So
it does the
if you
adjustable.
locked in at say 4%, you're at 4% for the entire 30-year term. Unless you sell the home or refinance it. Yes, you're locked in. Adjustable, because you touched on that. There are adjustable rate mortgages. We didn't talk about them too much here. But an adjustable rate, usually you're locked in for say the first 5 years at a rate, at a specific rate, say 4%. And then after that 5-year period, then it becomes adjustable. And where in a market of rising interest rates, you're going to see it continue to go up. So that's the scenario where you will see your mortgage payment increase, not just because your property taxes and homeowners insurance. You'll actually see your loan payment go up. And really escalating interest rates, that could cause a really big problem if you're in an adjustable rate mortgage. You're talking $200, $300, $400, $500 more every single month, depending on how high your interest rate goes. All right. Any additional questions on the current market trends that we're seeing? All right, we'll move on. All right, so I'm going to give it back to Steven here, and he's going to take it from there.
Thank you, sir. All right, we're going to talk about the process now. It is kind of a complicated process. It is a bit stressful. That's another reason why you need to have a good agent and a good loan officer that'll help walk you through this process. So first thing you would like to do is get pre-approved with a lender. That's, I think everyone knows that nowadays, but maybe not. Yeah, that's your first step. Pull your credit, verify your income, and verify your down payment if you have one. Those are the 3 major things that we'll do. Okay, so you've studied your numbers and decided you want to buy a home now. At the same time, you're connecting with a realtor, you want to be connecting with a lender. I'm going to suggest you research using a credit union as your lender, and here are a couple things to keep in mind. Costs, fees, and products vary by lender. Don't be afraid to ask lots of questions and find someone you're comfortable working with. Remember all those different loan types? A good lender will help match you to the right kind of loan. They can also help determine if there are any first-time homebuyer options that you may qualify for. Many of these are related to the location of the home you want to buy. And the definition of a first-time homebuyer is usually that you or someone else on the loan has not owned a home in the last 3 years. If you give several lenders access to your credit so you can be pre-approved, try to do it within a 2-week period so that your credit score impact is minimal. That is important. There's a lot of mysteries with credit and how it works and what affects your score. As long as there are mortgage lenders that are pulling your credit, you can have 10, 15, 20 of them do it if you want it. It won't hurt your score as long as it's within that. 2 weeks here, I've always heard 30 days.
It depends on the version of the scoring
Yeah.
system that gets used. 2 weeks is the safest.
Yes, let's be conservative. We'll say within a 2-week period. So if you are looking at multiple lenders, it's okay to have them each pull your credit, but just make sure it's done within that 2-week period. They all count as one inquiry on your score, but if you looked at an auto loan and a credit card and a personal loan all within that time, those are 4 separate inquiries, so those would affect you negatively. So as you're going through the home buying process, you don't want to apply for any other credit other than mortgage loan. All right, so if you sorry, I lost my place. So you will need to be pre-approved before you start shopping for homes. That means you will know the loan amount you qualify for, what the approximate monthly payment will be, and your expected interest rate. The lender can explain how the fees work and what other costs to expect. And now you can start looking for the perfect home. So Do your own research using the Colorado property website or others like Zillow. Your realtor can also set you up with MLS listings and can send you a list of current available properties. Once you have visited several homes, you can work with your realtor to prepare an offer. If it's accepted, you move to the next step. If not, visit other properties and make offers again until you get one accepted. With the way things are in our market, you may be making lots and lots of offers before you finally get one accepted. It's just the nature of the beast now. So if you're in that process, don't get discouraged. Eventually there is one for you out there. I've had experiences personally, and maybe you have too, of sellers accepting a lower offer because they just really liked the people that were making the offer. So it does happen. A good friend of mine had it 3 months ago. So when you get out there and you get discouraged, just remember there is one out there for you. All right, part 2 of the process. So you can see the list of all the fun things that get to happen. These all happen in order. Your purchase contract has dates that all these have to be done by. So it's spelled out black and white for you guys. Things start to move quickly, and approximately 45 days, you'll be going through all of these steps. I would say more 30 days is our
30
normal
days is
contract
pretty common.
nowadays, rather than 45. A home inspection is paid for by the buyer, and it is for your benefit to reveal any problems you didn't see as you looked at the property. The report from the inspector can lead to negotiations with the seller until a final contract is agreed on. If there's a homeowners association, be sure you can abide by the rules of the neighborhood before committing to the final contract, as we were talking about earlier. Also, the inspection is voluntary in most cases. We do highly recommend that you do get one. This is something different than the appraisal. The appraisal is actually just determining a value. Inspection is someone that actually goes through and makes sure everything works and there isn't any structural issues or anything like that. The appraisal will look at some very basic things. They might be able to say there's a hole in the roof or if the furnace doesn't work, but in general, it's just there to determine a value. So the inspection is important to make sure you're not buying, a house that's run down and going to cost you a lot of money in repairs. Okay, title work is ordered up to be sure ownership can be transferred and the lender will require an appraisal. This verifies that the property is worth the amount being loaned. You'll be required to obtain homeowners insurance, and of course, you are packing up and getting ready to move. It is very important that you do not seek any other loans or rack up credit card debt during this time. Your credit report will be examined again just before signing the closing papers, and big changes in your financial situation may put an end to the deal. I had a guy go out and buy a car 3 days before he's supposed to sign his loan papers. Don't do that. Please don't.
And don't change jobs.
Yes, don't. Yes, I had a guy retire 2 weeks prior to closing, and he didn't get to buy his house. He had already signed a contract to sell his house, so he had to go live in an RV at the KOA up there on was that North Shields, because he retired 2 weeks before he closed on his loan. It was Don't make any changes to how you get paid, your employment, or any new loans, credit cards, anything like that. Just focus on the mortgage. Once that's all done, then you can go and have fun and rack up a bunch of credit card debt. Okay, so after all of that, then you get to meet to sign lots and lots of documents. That's called your loan closing. You have, depending on the lender, it could be 17 pages to sign, it could be 30. Canvas, ours is pretty small, but you definitely need to do some finger stretches before you get in there, get that signature ready to go. Then you get the keys and move in. And congratulations, you are a homeowner. Well done, everybody.
And then just a quick online question that we may have glanced over, but are most people in today's market getting pre-approvals before putting in an offer?
You
Just
can't
curious.
can't put an offer in without that pre-approval.
It is required. Any seller's agent who accepts an offer without having a pre-approval is not doing their job, so yeah.
And a realtor that will let you put in an offer without it, it won't even be looked at. You have to have that pre-approval letter.
Yeah, because they're putting their reputation on the line to do that.
And along with that, the lenders who give these pre-approvals, really, we have to do our due diligence and make sure that really is an approval, because if they accept an offer based on, we said, yeah, they are approved for this loan, and then 2 weeks later, they find out, oops, no, they're not approved for that loan, we're not gonna be getting very many loans anymore. All right, let's move on to part 3. So we want to comment that home ownership doesn't end with the move-in, it's just beginning. You now get to make that property a reflection of yourself, and you get to maintain and invest in your new home. One of the advantages to being a homeowner may be related to your income tax check. So check with your CPA about that. So mortgage interest that you pay every year as of right now can be deducted on your tax returns, but that could change at any point in time. But that is one of the benefits of home ownership right now. So we really want to stress that you will make your life more enjoyable if you have a plan to save for the emergencies that will inevitably happen as a homeowner. There will be expenses you didn't think of, problems you didn't expect, and exciting projects you want to tackle. All those things take money, and having a slush fund set aside will make your financial position much stronger. Remember the windstorms we had here a few weeks ago? Blew my fence over. So I got to go and build a new section of fence, which luckily I had some savings set aside to pay for that. But that's just a small example of all the fun things that come along with homeownership. The common recommendation is to set aside each year 1% of the purchase price. So on a $300,000 purchase, you should be putting aside $3,000 each year, or about $250 a month. That seems high. Consider that a new roof can be $15,000. That's how much mine was 8 months ago. A furnace, $5,000. Refrigerator, $1,500. Exterior paint job, $5,000. Home ownership is not for the faint of heart or unprepared. All right, and research. So just kind of review here. Check your credit score. Prepare your budget, research lenders, research real estate agents. And then you have some resources there. Annualcreditreport.com is one I highly recommend. Again, that's the one where you can get a free credit report once every 12 months. So let's just do quick reminders about all the steps before you consider the home purchase. Some websites that help you with those steps are here as well. You can obtain your credit reports, check your accuracy at annualcreditreport.com. You can obtain your score by contacting a lender, or your credit union or bank may offer it as a free resource, or you can purchase your score through MyFICO. Look at your numbers and be very sure of how much you can afford to pay. We're going to suggest that if you are a member of a credit union, to check with them about mortgages and talk with friends or family who have purchased a home to get referrals to lenders and real estate agents. The other websites listed here are for property searches and general information about the home buying process. Any questions?
Yes, online. I might buy a car before a house. Ideally, how long should I wait in between?
Ooh, buy the house first if you can. Honestly,
Yeah, I suggest that too.
yeah, we're going to have to count that new car loan payment in your debt to income calculation. If you didn't have that car loan payment, you could afford more of a mortgage. But as far as timing goes, it wouldn't matter too much if it's going to happen before you get the mortgage. You know, if it's a month or so, 2 months, whatever, it all kind of works out the same. All right. Yeah, that was it, wasn't it? Here's our contact info. If you have specific questions, situations that are much more in detail than what we cover here, please feel free to reach out to us. There was somebody online that submitted a question earlier prior to the presentation about a 203B and FHA. I think that's a rehab loan. That's really specific and not very common, so we're not getting into that today. But if you are on there today, email Kevin or I, and we'd be happy to get into more details with that with you. Somebody else was asking about short-term rentals and things like that. This is a home buying class. We're not really dealing with rent or anything like that, but I believe the CSU Alumni has some kind of student housing. that can help with.
CSU Alumni Association will happily connect you with off-campus life for help navigating rentals. So we do have those connections.
Perfect.
Awesome. Well, I just want to say, I know we're a little bit over time, so we'll wrap up here shortly, but a huge thanks to Kevin and Stephen and Canvas Credit Union for supporting this series, as well as all of our CSU Alumni Association members. This series is recorded. You will all get a link to the slides from tonight, as well as the recording. And if you are interested in attending the rest of the series, again, they're the second Tuesday of every other month, so I believe that makes it July 12th. September 13th, and I want to say November 11th. The remainder of the series will be investing, buying investment properties, and building your financial team. So folks who should be on your financial team. We do evaluate and pick topics based off of your direct feedback. So if you want to say in topics for next year, fill out the survey that's coming with the slides and link to the recording. For folks online, we just popped that survey in the chat. And I haven't checked with Kevin and Stephen, but assuming you both are okay with it, we'll stick around for any final questions. But on behalf of the CSU Alumni Association, thank you for sharing your time with us tonight, and go Rams.
I don't know if that helps.